number is important because I believe that even in the third, clearly the volume growth number is important because I believe that even in the third quarter, volume growth may be marginally, at best about 1% positive. The Q2 numbers were also exceedingly, bad. And I think looking at the competitive intensity in the paint market and plus a slowdown in the demand, it's going to have a significant impact on the operating margins of Asian Paints. So I think outlook on operating margins, what is the kind of growth outlook for the volume number in the coming financial year? And I think what's the outlook on the competitive intensity? I think all these factors will be closely watched by the analyst, once the company announces its numbers and, has its con call. Because clearly, I think I don't perceive, at least for the next 3 to 4 quarters, any immediate revival, for Asian Paints. No, I think clearly, I think in terms of the profitable growth, I think the profitable growth is going to be very moderate. So I think, outlook on margins, Summit would be very critical because the jewelry business has grown quite commendably at 26%. I think what is important is, does this top line growth actually contribute to the overall growth in the EBITDA margins and absolute EBITDA? I think the markets are clearly looking at these kind of numbers. So I think now the commentary from the management would be more important. These numbers seem to have been discounted in the market price, but I think if the commentary going forward, no, I think the numbers which came in the quarter three have been good on all parameters. As you rightly mentioned, the top line growth, the margin improvement, plus the benefit on the bottom line has all got translated into better kind of absolute numbers. I would believe that, even at these levels, if somebody were to take a slightly longer term horizon, because for the last 2 quarters, we have seen, the numbers improving quite significantly, both in terms of volumes, in terms of value upside. So clearly, I think, from a longer term perspective, despite the fact that the company has announced a very large capex, I would not be surprised that, in FY26 also, we could see earnings recovery and even a very growth trajectory on the earnings side. My sense is that this could be a very good defensive stock in this kind of volatile market, considering the fact that this kind of volume number was not anticipated by the market. So I think some amount of re-rating even from these levels looks possible, but keeping a time frame of at least 12 to 15 months from now on. I think hopefully, Somit, FY26 should be a much better year, because clearly the markets were expecting that to happen in the current financial year, that is FY25. I think once that happens, you could see some sort of gradual re-rating on the stock because clearly, I think, in the past couple of quarters, the stock has underperformed. The performances have not been up to market expectations. So I think probably, you'll have to wait for another 12 to 15 months before we see the impact of the new acquisition, which I believe could possibly give a leg up to the margins. But I think till that time, the stock could remain in a very side range kind of activity. And the near-term trigger would be obviously the contribution from the new unit, which is expected in FY26. The overall, lubricant space has been doing pretty well. I think most of the companies have benefited from reasonable increase in base oil prices, which I think, was the earlier key factor in restricting the margins. I think Castrol as a company, sells its products at a premium to other companies in the market. And I think a double-digit top-line growth is something what the market has liked. If the company is able to maintain a double-digit growth in the coming quarters also, that would reasonably, one could expect that if base oil prices continue to remain, as they are, that would obviously give a much better leg up to the profitability. So I think numbers have been in line. The markets were probably happy to know that top line growth could grow in double digits. Normally, this is something which is little tough for a large player like Castrol. But nevertheless, I think it could be a market performer. I think other companies like Gulf Oil definitely have outperformed the market and has much better choices as compared to Castrol. So I think my guess is that, this quarter has been challenging, Somit. So, whatever tax concessions have been announced in the budget, it's going to take some time before the market actually gets all this gets reflected into actual numbers. So maybe the January to March quarter or the April to June quarter could be a stronger quarter. But even valuations have gone up quite significantly. I think levels from 1400 odd when the uptrend in Trent stock started, the stock has seen a dramatic increase. So I think clearly one is the valuation part. The stock is correcting because valuations had become fairly expensive. And secondly, consumption has been hit badly. So I think for the cycle to turn again, probably you'll have to wait for a couple of months, and probably the March quarter or maybe the April to June quarter could be, some sort of a much more normal, stronger quarter for Trent. So we continue to be positive in the longer term, but yes, in the short term, you would expect a little volatility on the stock. Company is that soda ash prices have weakened considerably. And if this continues, then their realizations go down, and obviously to that extent, they would not be recording a profit. Of course, this quarter there was an exceptional item of 70 crores. But even without this item, I think operating, margins are going to be under pressure unless soda ash prices start moving up, which looks unlikely in the near term. No, I think as of now, it looks a little tricky as to which companies benefit and which companies don't benefit. But I think clearly, my sense is that if the tariff war continues, then I think longer term it's going to be extremely volatile for companies exporting to such markets, specifically if it is Mexico, Canada, or the US. So I think we'll have to wait for the numbers to come in. But my sense is that possibly you could see a little bit of operating margins coming under pressure if the tariff war increases. And it's not going to be easy for these companies to pass through these increased tariffs to the end customers, because it's a very competitive business. So I think sectors like auto components, where most of the players operate on a volume kind of mix rather than on a value mix. I think those companies, like Bharat Forge or typically a Sona BLW, could see little bit of margin pressure unless they are import substitute products where entirely the vendors are supplying to the entire requirements of those customers. So I think we'll have to wait and watch. Right, frankly, as of now, very difficult to pinpoint which would benefit and which would be negatively impacted immediately.